So, Mike, when I talk about reverse mortgages, when I bring up the subject, people get super nervous. What are the concerns with reverse mortgages, and then maybe like how do you overcome those objections?
So I think a lot of the concerns are based on problems that happened in the past.
Mm-hmm.
So some common misconceptions about the reverse mortgage is that the bank now owns your property.
Mm-hmm.
That's a concern that comes up frequently, and it's just flat out not the case.
Okay.
So the Federal Housing Administration, FHA, started regulating the industry about 25 years ago. So a lot of the horror stories from decades ago really don't apply any longer. The loan is very much like a traditional mortgage. You're the owner of the home, and unless you default by not keeping your property taxes current or your homeowner's insurance current, the home will remain yours.
So there's no risk of the client losing the house.
If they maintain the home as their primary residence, keep the property taxes current, keep homeowners insurance current, then there is no risk. Because there's no minimum payment due every month, there really is no default risk.
I was reading an article the other day, and it was saying that more and more, more seniors are turning to reverse mortgages. Just maybe they didn't have as much set aside for retirement. They paid off their house. Are you seeing that in your practice?
For sure. So we're starting to work more and more with financial planners, wealth advisors that are seeing this tool, if you will, as as a financial tool in someone's retirement plan. So as often can be the case, someone may have the majority of their net worth tied up into their primary residence.
Sure.
And to be able to unlock that to supplement retirement for whatever reason is a big help. And it doesn't put all of the onus on their retirement account. Where wealth advisors, where they lean into this program is if they have a client that's just beginning to draw down too heavily on their retirement assets and run the risk of burning through those too quickly. So to have a primary residence as a source of liquidity is a huge advantage. And to be able to access those funds without a monthly payment obviously is a huge advantage to the client in managing cash flow.
So why not just do a traditional mortgage? Like where does a reverse become more advantageous than just doing like a cash out refinance or home equity line of credit? Like why not do that? What's the difference?
And we do have clients that are tapping into home equity with a traditional home equity line of credit. It's a perfectly good method if you can, one, qualify for that type of financing and are okay with the monthly payment. So with the reverse mortgage, the big advantage is the flexibility of the loan. Because it's a truly payment optional loan, the monthly payment that would normally be due with the traditional mortgage, due on the 1st, late on the 15th, is an optional payment. So it gives the client that much more flexibility in accessing cash without the burden of having to make a monthly mortgage payment. Now, the payment is optional. So if someone wanted to minimize their interest expense, they could make a partial payment or a full interest payment. It's really totally optional.
Can we talk more about how that optional payment works? Like if you decide not to make a payment, what happens with the loan?
Yeah, so like a traditional mortgage, there's an interest rate. And the interest rate, for the most part, is pretty comparable to where traditional forward mortgages are. If you choose not to make a payment, that interest expense that accrues at the end of the month just gets tacked onto the balance of the loan. And there is no maturity date to the reverse mortgage, so there is not a balloon payment coming. as long as the borrower maintains the home as their primary residence, continues to live there, keep taxes and insurance current, there is no payment due.
And I think that's the fear and the misconception. I think the fear is there's going to be this giant mortgage due and that mom and dad are going to lose the house and the bank's going to come for the house. But there is a provision within the documents that says that as long as you're living there, as long as it's your primary residence and you're paying your taxes, you're good to go.
That's right.
Okay.
So it's really, in terms of risk to the borrowers, they have a greater risk with a traditional mortgage because they have a payment due.
Right.
On the 1st, late on the 15th.
That makes
if
sense.
they run into a cash flow problem, there's a much higher likelihood that someone would default on a traditional mortgage than they would with a reverse. Because there's no payment due, it's really just a matter of making sure that the borrower is capable of keeping property taxes and homeowners insurance current. If they do that, they keep the home as their primary residence, there really is no default.
So how about, when we do a traditional cash out refinance, the option is basically we're going to give you all the cash in one lump sum. Is that the same with reverse mortgages, or do those come differently? How does that work?
That's a good question. So there's really a few different ways that the borrower can access funds.
Okay.
They could take it as a lump sum payout on a fixed rate. The majority of our clients are looking at accessing their funds in a form of a line of credit.
Okay.
So that allows them to draw against the funds as they need them, when they need them. The interest expense then is only accruing on whatever they've drawn. So it gives the borrower, the flexibility of, again, drawing what they need when they need. We can set it up if someone wants it kind of on autopilot. We can set up a monthly draw for the lifetime of the borrower. We could pick a number if they need, $2,000 a month or $3,000 a month. They don't want to have to go through the exercise of requesting it every 30 days. We can set that up as well.
So I'm going to go to the mailbox. There's going to be a check. It's going to be, or it's going to be deposited in, and every month I'm going to get $2,000, $3,000 for forever? Is that how that works? Or
for as long as they live and maintain the home as their primary residence. And the way we come up with that number that's available is a formula based on the age of the borrower and value of the home.
Okay.
So not everyone just has an open checkbook, but once we've determined what the maximum loan amount is, then we can set up, the best possible method for how they want to access those funds. So once we've determined, what the maximum loan amount is, we'll give the borrower the option: do you want it all at once? Do you want to draw it as you need it, or do you want us to set up a plan to where it's kind of on autopilot and you really don't have to do anything? In any case, whatever way we decide with the client on how to access those funds, it's never set in stone. They can always change it as they go. So it really is the most flexible mortgage loan on the planet.
So I've seen this with some of my clients. You've got kind of older clientele. Husband was the breadwinner. They did a great job paying off their mortgage. They did what they were supposed to do. Didn't really have a whole lot of savings. Weren't worried about it because they had pensions and retirement and everything was going to be fine. But then when one spouse passes away, the other spouse is left to do everything. They've got maybe Social Security and a small pension, but really not enough to kind of deal with the other expenses that come up. And then they don't want to take out a loan because they don't necessarily qualify for that loan. Is this the client that you're looking for ideally?
Well, that is definitely one scenario that's kind of a perfect for the program.
Yep.
It really kind of solves two things. One is the scenario you just described could potentially be a cash flow problem.
Yeah.
Or at least a strain. So even if we can set up a line of credit to just supplement what an individual is drawing on, either from Social Security or a pension or an IRA,
Yep.
And even if it's just set up as a safety net, that alone can just alleviate some stress. Then with regards to the ability to qualify, because there's no payment due, there is no income qualification. So it really is based on age of the borrower and property value. Those are the two variables that kind of indicate what we can loan.
And that's been the problem I've seen with my clients, right? Where we get to this age where it's like, you don't have any more income, we can't qualify you for a loan. They have a ton of equity and they can't touch it at all. So this solves that.
Yeah, and 10, 15 years ago, there were loan programs that were much easier to get without qualifying based on income, but those days are pretty much over. So in terms of qualifying for a home loan, it's one of the few ways that we can get someone into a loan without needing income to qualify.
Yeah. So one of the things that I've heard is that it's a longer process than a typical loan. Is that true? Like, is it something that can go quickly?
Yeah, it does take a little bit longer than a traditional refinance.
Mm-hmm.
There are some steps involved.
Okay.
A couple of them really are to protect the consumer.
Yeah.
So one of the safeguards that the Federal Housing Administration put in place years ago is they require mandatory third-party counseling before a reverse mortgage applicant can get into contract.
So what's that look like? Is that like online? Is that they go to a class? What's that look like?
Yeah, so there's a couple of different ways the consumer can access the counseling. Most will do it over the phone.
Okay.
So they kind of make it easy. They can do a Zoom call or just a regular call. There are some agencies that will do it in person.
Okay.
And the purpose really is to make sure that we as the loan originators are doing our job in explaining the loan program correctly to the consumer. So they're kind of the industry watchdog,
Mm-hmm.
which is a great thing to have actually, because it ensures that we're doing our job explaining the product appropriately. Our mission really is by the time our clients get to the counseling session, they really aren't learning anything new. But that process adds a week or two to what would be kind of a typical refinance timeline.
Yeah.
They've got to go through that counseling. Once they get their counseling completed, there's a 1 week cooling off period, at least in California, before we can issue a loan application.
We're not pushing. We're saying, take a look at this, think about it, take a week.
I mean, the typical process is we're putting a proposal together for our clients that outline the numbers. All of the frequently asked questions are a part of that, and all of the information that is required to get through the counseling. Then counseling is kind of the next step. They get through the counseling. At that point, it's like, okay, now you got a week to decide whether or not this is something that you'd like to move forward with. And by that point, I think, generally speaking, clients are pretty clear as to what they want to do. And then from that point forward, it's usually about 30 days.
So, interesting scenario that just came up for me. I have an older couple who are looking at buying a house. However, one of the how do I say this? One spouse is actually exhibiting kind of early signs of dementia. So in that scenario, usually as a loan guy, like I'm out. Like if there's any sort of dementia, we don't want to do that loan because we can't be sure that the responsible party is acting in the best interests. This must be something that comes up a lot with reverse mortgages, as far as, because you're dealing with a clientele that's closer to an age where dementia is more common, right? What are there safeguards in place, or is it a deal breaker?
Well, for sure there are safeguards in place. This is where HUD steps in, Housing and Urban Development.
Mm-hmm.
They've got very strict guidelines on power of attorneys and being able to use them. Obviously, in the interest of the consumer, and just to protect older consumers against anything that could be construed as not in their best interests. Yeah. So to answer your question, it's actually a little more difficult to get a reverse mortgage closed if there is some issue or potential issue with a cognitive situation.
Yeah.
So we really, we like to bring the family into the picture kind of as soon as possible.
That makes sense.
And there are ways to kind of get the deal done, but it does get a little more complicated. Not to get too far off track, but it kind of gets into some estate planning issues. And, we do work with some estate planning attorneys that have seen the benefit of getting a power of attorney in place long before it's needed. And that's kind of the key in the eyes of FHA and HUD, is the last thing they want to see is a power of attorney getting slammed into place so that we can get a reverse mortgage done. They simply won't allow it. So that power of attorney needs to be in place. A durable power of attorney needs to be in place far enough in the past that there's no issue or idea
that makes sense
that the individual issuing the power of attorney or granting the power of attorney was not of sound mind at the time.
So before you talk to the loan guy, before you talk to this, you had already set up a power of attorney just in case something happens with grandpa's health.
Yeah, I mean that's that's not really our world, but it's the message that we're trying to send to the estate planning industry as a precaution.
Okay.
When you've got clients coming in, hey, I mean, if you can get that power of attorney established years in advance of ever needing it, that will go a long way into allowing them to use that power of attorney, because then it doesn't come into question whether or not they were of sound mind when they issued that.
Got it. So are you recommending to your clients, maybe your Ford mortgage clients, that they start looking into getting a trust and an estate plan set up?
For sure. I mean, everyone that comes into our office, we're always kind of looking out for their best interest, whether it's financial planning or insurance, estate planning. And so, we've got, a number of professionals that we kind of rely on that we can refer our folks to.
Yeah. I think especially in the financial world, it's so important to have people that like, and trust. So I had a client who was looking to buy, but they didn't qualify. And you were talking before about maybe how clients can qualify for a reverse mortgage as a purchase. So it's not just a refinance to pull cash out.
Yeah, and using the reverse mortgage in a purchase scenario is a great tool that not many understand or know that it's available. So the loan works just like a traditional reverse mortgage. We're just putting it in place at the close of escrow.
Okay.
So a typical scenario is maybe someone downsizing, they're selling their current home, they walk away with, say $500,000 in cash.
Yeah.
They think that at that point their only option really is to find a replacement property
for $500,000.
$500,000. Yeah. Where we could potentially come in, for example, and put a $300,000 reverse mortgage in place. They bring in their $500,000. Now their purchase price is up at $800,000. So they're in a home that maybe is more kind of where they need to be. It accomplishes their mission of not having a mortgage payment. And because there is no mortgage payment, they don't have to qualify for that $300,000 reverse mortgage.
And it does seem to happen, right? It seems like we give someone a budget and they always want to find something that's just a little bit above that, right?
Well, and it's particularly in California, it's super common. To have to go all cash can be a tall order. So even if we just have to come in with 10 or 20 or 30% of purchase price and kind of bridge that gap between what our client has in cash and the purchase price they're really targeting, that can go a long way. And to be able to do it kind of simultaneously in the purchase transaction, we're not requiring them to come in with an all-cash deal, close, and then refinance out of it. We do it all at the same time.
How are you seeing, I guess, what's the response that you're seeing from listing agents and from buyer's agents? How does the real estate community react to this product? Because I know it's not common.
It's
right?
not common. I mean, many are surprised that it's even an option.
Yeah.
And so we're trying to get the word out because it is a great alternative. It's a great option for someone that just cannot get into the price point they need with the cash they have. And even if they have the cash, it might be better suited if they don't have to put all of that into the transaction.
That makes sense.
And we did a deal, not too long ago where that was exactly the situation. Our borrower sold a home in LA County, came up to Northern California. We were able to allow them to keep some of the proceeds from the sale of their home in LA, put the difference as the down payment, and we bridged the gap with a reverse mortgage. So they got into the home at the price point they needed.
Yeah.
They were able to pull a couple $100,000 off the table to put into savings, and they don't have a mortgage payment. So it kind of solved everything.
Yeah, sounds like a safe and secure purchase, right? Yeah, that sounds fantastic.
One of the questions that usually comes up, whether it's a reverse mortgage in a purchase scenario or on a refinance, is, how quickly am I chewing up my equity? If I choose not to make a payment, my interest expense is just accruing and adding to my principal balance every month.
Yeah.
And that is the cost. What we will do with our clients is show them an amortization schedule.
Okay.
Because we know what the interest rate is on a fixed rate, what it's expected to be on an adjustable rate, we can pretty easily forecast what the principal balance will be every year, assuming no payments are made.
So you can look at it and know this is where it'll be in 5 years, this is where it'll be in 10, 20, 30 down the road.
Exactly.
Okay.
And then we'll make some assumptions based on appreciation.
Right.
And since that equity is always the borrowers or the borrower's heirs, they're continuing to benefit from any appreciation in the home. And in most cases, because we're loaning such a small percentage of total value, the equity in most cases is growing over time.
Okay.
So even though our principal balance is, in theory, assuming no payments are made, they're growing in tandem, but that appreciation on the home is on the total value of the home, which could be 3 times the amount of the of the mortgage.
Yeah, we've seen.
So it's out in most cases. If we're looking at really 3.5-4% appreciation or more, chances are the equity is going to outpace any interest expense.
Which is what most of California's been.
Which is what
historically.
And so that the fear that we're chewing up our equity super quick. The reality is we're probably not in most cases. Again, we're forecasting usually based on a 3, 4, 5% appreciation rate, and in those cases, we're going to show the client that they're probably going to be increasing their equity position over time.
That makes sense. If someone already has a reverse mortgage, is this a one-size-fits-all product, or is it something where it does make sense to take a second look to maybe say it might be worth refinancing this, it might be worth changing it, or is it just once you have a reverse mortgage, you're good, have a nice life?
No, just like any other mortgage product, if rates come down, it might be worthwhile to look at a refinance. Maybe you put the reverse mortgage in years ago and your property value has increased significantly since the original reverse mortgage.
Sure.
We can revisit and maybe increase that line of credit or increase that amount that is available. So there is no prepayment penalty on the mortgage. So we'll look at refinancing if it makes sense.
Okay.
If it either lowers the interest rate or increases the amount that's available, we'll look at refinancing an existing reverse.
So one of the things you talked about was having financial advisors, working more with financial advisors. If someone is coming to you, do you have financial advisors that you can recommend to them to talk about kind of how to use this in tandem with a kind of an estate planning strategy?
Yeah, so we have a number of wealth advisors and financial planners that we have long relationships with that we trust that will refer folks over.
Yeah.
But what we're seeing more recently is the wealth advisors and financial planners reaching out to us as the loan originator, trying to understand this product. And, frankly, in most cases, individuals have some kind of negative connotation when they hear the word reverse mortgage. And it really kind of dates back to, I think, some of the horror stories from decades ago. But because there's so many safeguards in place now, the product has become, much more in line with traditional mortgages, and the days of lenders kind of creating their own guidelines are over. And so now you've got the wealth advisor community, the financial planner community reaching out to us to help their clients in restructuring their entire retirement plan. The last thing anyone really wants is to drain their liquid retirement.
I mean, it's the biggest fear, right?
Too
The biggest
quickly.
fear is running out of money, right?
For
In
sure.
retirement, I don't want to run out of money.
And people will say, well, but I'm borrowing against my home. I'm paying interest. Well, there is an expense to accessing that equity. But there's also an expense to drawing against your portfolio. Nothing is without a cost. And to be able to have options and kind of, marry the liquidity from your portfolio with gaining liquidity from your real estate, just opens up doors to be able to just plan better. It's not that if a reverse mortgage is possible, you need to do it. It's really, how does this financial tool potentially work into your overall retirement plan, and does it make sense to access it? I'm working with a financial planner right now, and their client is basically relatively young. They're 62, 63.
Okay.
We're looking at putting a reverse mortgage in place for them now, and they don't really need it at the moment. But they are looking at this as a backup plan should there be a severe market correction. Because the last thing someone wants to do is draw down on their retirement account during a down market. If there's a 10, 15, God
my
forbid,
portfolio is worth this, and
that's
pulling
not
a
what
bigger
you want.
percentage. Yeah.
Exactly.
Okay.
Now your drawdown on that retirement account becomes a much bigger percentage of what it was 2 months ago or whatever. To take a pause, and maybe that's the time, if we need funds, to draw off that reverse mortgage and just hold off on drawing down on the retirement account. I think that's super savvy.
I love
retirement
that.
planning.
And then once that account starts taking off again, we'll start those distributions again from the
because there's
IRA.
no prepayment penalty on the reverse, there's nothing to prevent someone from paying that interest expense down in the future. But just have the flexibility of being able to access liquidity from multiple sources
and
is
stay
a
in the
huge
market,
advantage.
right? Like, I mean, that's always the counsel is stay in the market, right? Like, it's the Warren Buffett thing where it's like, he buy and hold.
That's right. And so that's it's nice to see the retirement planning community kind of understand the product, and again, because there's so many safeguards in place, they're treating it as it's a financial tool. It's not one size fits all.
It seems like a really good opportunity for just synergy between the two industries, right? Which I think is ideal, right? Then you have someone who's planning the whole thing and working together.
We love, working, we love working with our clients' advisors.
Mm-hmm.
It's, it just makes sense if we can pull people in, if they've got a CPA, they've got members of the family. It's like, let's get everyone kind of on board,
Yeah.
And make sure everyone understands how the product works and, how it would benefit them during their retirement years. One of the questions that comes up frequently is, well, what happens when I pass away? I've heard,
Yeah.
Is that when it goes to the bank?
Right.
It
We're not dropping that, right? We all believe that the bank is taking the house, for sure.
Just like heirs settling a estate,
Yeah.
where there's real estate involved and a traditional mortgage, it works pretty much the same.
And we see that all the time.
The heirs inherit the property.
Yep.
If there's a mortgage, they've got to figure out a way to settle it. Either they're going to refinance if someone in the family wants it.
Okay.
They've got to refinance that into their name, or they sell the home, they pay off the balance of the mortgage, and the equity is the heirs. The reverse mortgage works exactly the same.
It's a loan.
The heirs inherit the property. The nice thing about, well, I shouldn't say the nice thing, but one of the benefits of a settling an estate with a reverse mortgage is that because there's no mortgage payment due, while the heirs are dealing with settling the estate, they're not having to keep a mortgage payment current on an existing mortgage.
Yeah.
And so it gives them some breathing room as they're dealing with what they're dealing with. Generally speaking, FHA will give the heirs basically 4 90-day periods to settle that estate.
It's a long time.
Yeah, as long as the heirs or whoever's dealing with the estate, as long as they're making reasonable progress, if they need to do work on the house, as long as they're communicating with the loan servicer that they are working towards a resolution,
working towards it.
there really is no reason that the note would be in default. So again, usually FHA will grant, up to 12 months with extensions to get that estate settled, and then whatever equity is available, that's the heirs, just like a traditional mortgage.
Are there limits on the size of reverse mortgages? Is it like I know when we do conventional, we have conventional loans and jumbo loans on traditional mortgages. Are there jumbo reverse mortgages? Is that a thing?
Yeah. So there really are kind of two main categories, if you will, of reverse. So FHA, the Federal Housing Administration, they have their program. FHA will have their loan limits, depending upon where you are in the country. Different parts of the country where the FHA loan limits just aren't going to be enough. We will have quote unquote jumbo programs, and they are also known as proprietary reverse mortgage programs. So they're non-FHA.
Yeah.
FHA will still regulate, and most of those proprietary programs follow lock and step with FHA guidelines. So they look and feel very much like an FHA reverse mortgage, but the loan limits will go up to $3 million. A couple of investors will go up to $4 million. So this program, again, really helps folks that are in parts of the country, like the West Coast, where we've got much higher property values,
Sure.
and where the FHA loan limits kind of stop us.
Because it's still 50 to 60% of equity, right? Like we're still looking at so if we're looking at a $3 million reverse mortgage, we're probably talking about a $6 million property value.
Yeah, so correct. And 50% is probably on the high side.
Okay.
So the loan amount is going to be dependent upon the age of the youngest borrower. On the jumbo or the proprietary programs, that minimum age is 55 years old.
Okay.
On the FHA program, it's 62 years old. As you are at the kind of the lower end of the age bracket, they're going to cut that loan to value down somewhere in that 35 to 40% range.
Okay.
As you get a little older, the program will inch up and will end up closer to 50% loan to value. But it's not intended to over leverage the borrower.
Yeah.
And those low loan to values are for a reason. They want to make sure that there is always equity in place, and that there really is never a circumstance, regardless of how long the borrower lives, where they're going to run into an equity problem.
It seems like that's also like a really good fail-safe, though, right? I think if the fear is we're going to lose the house, which is kind of this idea, the fact that you're only borrowing half or less than half,
Right?
And then yes, that will accrue over, like interest will accrue over time, but also like you said earlier, the equity will accrue as well, and it's hard to catch up if you start at 50%, right?
That's right. But the what if? Okay, so what if there is a situation, market conditions. My grandmother lived to be 106.
Mm-hmm.
Now, she didn't have a reverse mortgage, but if she took a reverse mortgage out at 62 and lived to be 106,
Mm-hmm.
that's a lot of years in that reverse mortgage.
Right.
If she never made a payment, that interest could accrue.
Yeah.
And let's just say someone passes away,
Mm-hmm.
and the principal balance exceeds the value of the home.
That's the big fear.
That
right?
is the big fear. Now what happens? Well, the loan is a non-recourse loan to the borrower and to the borrower's heirs. So what
Okay.
that means is if there's ever a shortfall, meaning the principal balance of the loan when the loan becomes due, if the principal balance of the loan exceeds the value of the home, FHA will insure the lender for any shortfall, and the value of the home really is all that's required of the borrower or the borrower's heirs.
So does that create like a short sale then?
Well, it avoids a short sale.
Okay.
So let's just say the principal balance at the time the borrower passes away is $700,000,
Mm-hmm.
and it's determined that the home value is $600,000.
Mm-hmm.
Well, at that point, there really is no equity.
Right.
But the negative equity is not the responsibility of the heirs. They're giving the property back to the lender, and then the lender deals with it. The lender has a shortfall. That's where the FHA insurance covers that lender. It's why the program exists and why interest rates are comparable to traditional mortgages, is because the lender knows eventually they're going to get repaid. Think about it. The lender is in a position where they're, potentially out millions of dollars in a loan.
Yeah.
Depending upon the age of the borrower and how long the borrower lives, they may not see any repayment of that investment for decades.
Mm-hmm.
So why would a lender, invest in a mortgage where they're not seeing any repayment for potentially 30 plus years? And the answer is they know eventually they will get paid, because they've got the assurance of the property value, and they have the assurance of the Federal Housing Administration that if there is a shortfall, that they'll be covered.
So you've been doing some pretty cool loans. I saw that you did a bank statement loan for a client recently. How does that work? So they were self-employed. I know they were moving from far away. Like, how does the bank statement loan program work?
So a lot of our self-employed borrowers will they tend to write as much as they possibly can off of their tax returns
To limit their exposure.
to limit
Yeah.
their income tax exposure. It's a very common problem with anyone that is self-employed. They know exactly what I'm talking about, and so the industry has created a form of underwriting that is really tailored towards self-employed borrowers. And so what we'll use in lieu of tax returns is just the business bank statements. So the business bank statements will show that income coming in from whatever their business is.
Okay.
Whether it's landscaping or whatever. It really doesn't matter the industry.
Yeah.
If we have, 12 to 24 months of business bank statements that evidence incoming deposits, we will use that. Our underwriters will come up with an expense factor, and now we've got a new form of income for qualifying purposes. And in most cases, it's far in excess of the income that we are generating using tax returns.
And so you're able to qualify people that traditionally wouldn't qualify. So these are clients who maybe went to their bank, went to their normal financial institution, and their bank told them you can't buy a house. Whereas once you've looked at the bank statements and we've analyzed it, then these are actually people that can buy right away.
Yeah, no, it's an amazing program. It is relatively new. A lot of the commercial banks probably are not in this type of business or doing this type of underwriting. It's not subprime.
Yeah.
These are, quote unquote, traditional loans. They're just using non-traditional forms of underwriting.
Right. And now that they're starting to be more commonplace, there's a longer, because we have more data on them and they're performing well, meaning clients are making their payments, we're starting to see rates get even a little bit better on these products.
Yeah. It's opening the doors for folks that maybe had trouble qualifying with traditional underwriting.
Sure.
Whether it's bank statements and there's also alternatives to even the bank statement program.
Yeah.
If you've got a CPA that's willing to issue profit and loss statements. We could potentially use those in lieu of tax returns.
We just put together a debt service coverage ratio, so a DSCR loan, which was super cool. So this client, great guy, does a great job, just doesn't really want to deal with all the paperwork. Just doesn't want to deal with. He has a lot of assets. He doesn't want to show all of his assets. He doesn't want to necessarily turn in, tax returns. He's got multiple properties, and it was fantastic. We needed lease agreements and appraisal, and we needed to know what the market rents were, and that was really it. And then the loan was approved based on that. And this guy's buying a $1.8 million property in Monterey and putting down 25%.
And so this is for investment properties?
Investment property only, yeah. He's picking up. This is a 3-unit property that he's picking up, and the thing that was great about it is we've done loans for him before, and just the minutia. We didn't have to deal with kind of all of the, what's this write-off for? What's this, we see a large deposit over here in this account, and it was just so much less paperwork. And he really enjoyed the process and was good with the process, whereas in the past he maybe thought it was a bit laborious.
Well, I think with anyone that has, at least a couple of properties, that show up on their tax returns. Typically, with traditional underwriting, what would you need to get a loan approved if someone's showing, whatever,
Oh my
1,
gosh.
2, 3 properties?
All the things, right? You need a rental agreement. We need to see tax. We need to see property taxes. We need to see insurance. We need to see the past 2 years of rental history via the tax returns. So and that's per property. And so when you have 2, 3, 4, 5 properties, it can be a lot, and it's a lot of paperwork to keep all that, and to have to submit all that paperwork in the time frame, get it all checked off and looked at. It can be a lot for sure.
So with this loan you're describing there, you're really just looking at the subject property.
Yeah, and it really is. Does the property cash flow? If it cash flows, then this is going to work. And in some cases, if they put enough down, it doesn't even necessarily fully need to cash flow. If they're putting 30% or more down, it can show a bit of a negative.
Does the property need to be leased at the time you guys do the loan?
No, it can be vacant, and then we'll do market rents, meaning the appraiser will go out and look at comparable properties that are rented in the area, and they'll get a market rent survey and say, hey, this typically rents for that, this typically rents for that, and we'll use that number in our calculation, and as long as it still makes sense, then we go with it.
And this is not hard money type of financing?
No, although there is some interesting stuff. So we haven't had prepayment penalty loans on anything in a long time, since 2008. Really, we haven't had prepayment penalties. These products do allow prepayment penalties, and so what you're basically essentially saying is, I'm going to take this loan for 1 year for sure, or 2 years for sure, or 3 years for sure. And if you are willing to make that commitment, the rates come down considerably, to the point where on some of these, the rates are actually lower than like a regular traditional Fannie Mae, Freddie Mac loan that has more of the documentation. So they can be just a really sharp product for investors. If you're somebody who's buying the second or the third or the fourth or the fifth property, then it really does make a lot of sense.
And to not have to submit tax returns, I would think, as long as the deal itself makes sense, you're not subject to grinding through all the traditional debt to income ratios and all of that. Is that correct?
I think so. And I think it makes sense because that's the profile of these clients as well, right? Like typically people who are buying second, third, fourth properties are not, that's not what they're doing for a living. They have another source of income that's allowing them to invest, right? And so if you have someone whose primary focus is working on XYZ, it can feel like a full-time job getting a loan done, right? And so this alleviates a lot of that stress. Well, I guess it is a full-time job getting a loan done, since that's what we do.
but not for the client.
Not for the client, yeah. So the other one that I saw that was really cool is, did you do an asset qualifier loan?
I did.
So how does that work? So what's the qualification? What's that look when it?
Yeah,
I guess
so we had so we were working with a client that had recently sold his company.
Yeah.
He had found the home and that he was going to retire into.
Okay.
We did have to he did have to close on the sale of his company. Mm-hmm. But he was only using a portion of the proceeds from the sale to purchase the home.
Okay.
And we were able to give him a loan for the balance because he was trying to create a situation where he wanted the majority of the proceeds from the sale of the business to go towards his retirement account. So he was really
Makes
trying
sense.
to minimize his cash infusion into his retirement home.
Okay.
So because we need quote unquote income for qualifying purposes, we had to look to an alternative source.
Yeah.
We don't have tax returns because he doesn't have any
sold his
traditional.
company,
He just sold
right?
his company. He hasn't started on Social Security. We don't have a pension. We don't have an IRA, but we do have an account now with enough liquidity that we will run a calculation of what is reasonable income based on the amount of assets that he had. And based on that income calculation, we were able to qualify him for, I think it was a 70% loan to value. So it was a significant loan on the purchase of that property. But he really had no traditional income for qualifying.
That's fantastic. We're doing a loan right now for a client who used a lot of money to purchase the house, and he bought the house cash, and now he wants to come back and take money out of that. And so it's the same thing where we're using his assets for qualifying, but there's a cool little niche inside this program that the money we're taking out can also be counted as part of his reserves, which is phenomenal. So he's taking out $1.5 million, and we can use that $1.5 million to qualify him as income, which was mind-blowing to me.
Now, do you ever run into a situation where maybe your client is needing to move? Mm-hmm. They are heavy equity, meaning the majority of their net worth is tied up into the equity of their home.
Yeah.
They have minimal liquid assets, mm-hmm. but they do need to move, and they need to buy before they can sell their current home.
Yeah. Yeah, we've got a couple of ways to do that. So there's a few. The one thing that we do have, we have a proprietary product with Cross Country, which is awesome. It's called a Cross Country bridge loan. And so we just did this for a client. She has a home that had a mortgage on it, had a lot of equity, and she wanted to buy. She basically wanted to move up. She moved here a few years ago, had a house with a great rate. She needed to. We could pull up to 80% out of the house that she was leaving on this bridge loan, and then we use that for the down payment on the new house. And the cool thing about that is that that she doesn't make a payment on that bridge loan for 4 months. So the area she lives in, they're going to put a for sale sign on that house, and it's going to sell in a week. But it was just a way that was because she is retired, and most of her assets are in these retirement accounts. She didn't want to take that money out because then she'd be facing taxes. And so in essence, she literally did 100% financing, right? So she pulled out this down payment plus closing costs, and then she put that into the new house and was able to get a 30-year fixed loan on the purchase side. And one of the things that was useful in that is because she did have a lot of reserves, and because we left 20% equity in the departing residence, we didn't count that house against her. So we didn't count the payments on either of the loans, and we only qualified her on the new one, which was fantastic. So she was very excited about the idea of being able to do it without really much personal investment other than the equity of the home.
Right. So you're using the equity on the home that they're selling, and that becomes their down payment, essentially.
And I find that that's a lot of the clientele right now. People want to buy before they sell. I think a lot of the clientele we have are either right sizing or moving, and maybe that's the area we work. I mean, we don't work in the worst areas in the world, right? So maybe people are coming here to retire, and they don't want to pull money out of their retirement account. They'd rather, is there a way we can take it out of the house? And a lot of times there is.
Right. Yeah, being able to counsel our clients on ways to buy non-contingent on the sale of their current home. I mean, we're not in a market, at least at the moment, where a contingent offer is getting looked at very favorably. So are there other ways? Let's say we've got a client that's retired.
Yep.
And they can't necessarily qualify for the loan on the new property, and they're really just trying to trade equity.
Yep.
But they need to buy before they sell.
Yeah.
Is there, are there programs that allow just like a true bridge from one property to the other?
Yeah, there are for sure. And I was actually just talking to a realtor friend of mine, and I've done more bridge loans in the past 3 years than I've done in the past 20. Like all of the sudden, and I think it's how the market moves and there are cycles, but it does seem to be the way a lot of people are buying these days. They do a bridge loan. So the way that works is you look at the combined value of both properties, and then the companies, depending on the company, will lend anywhere from 60 to 70% of that, which if you've got a paid off house and you're retired and you want to buy another house, you can a lot of times do 100% financing.
Right.
We have some investors that will actually let you roll in the closing costs, and we have some investors that won't. But it's an interesting area that seems to be getting a lot of attention, and it's something that traditional banks don't do. So we see it a lot. I think since we started talking about bridge loans, we've done at least 1 or 2 bridge loans a month for probably the entire year, which is a weird stat, like from never doing them before. Now it seems to be the way it gets done.